Hello property navigators. Today we'll be covering off some great areas we believe you should consider investing in Southeast Queensland between the $450,000 and $600,000 price range that provide both strong imminent price growth potential and strong cash flow. I'll start at a macro level and introduce two particular regions, then I'll finish at a micro level by zooming into two particular suburbs that are our picks for you today. I'm going to talk about two cities that are within the 1.5 to 2 hour driving distance from Queensland's capital, Brisbane. These are what are called regional cities. Now, there is no one-size-fits-all when investing, so today's discussion will focus on purchasing both houses and duplexes. Why? Well, to simply tell you a region and suburb to go and buy a property isn't really that helpful, because you need to have a think about what asset type you need to buy that fits into your own personal investment strategy. Depending on your stage of investing, you might need strong capital growth over cash flow, or you might need immediate strong cash flow over capital growth. These areas I'll introduce you today are strong in both, so the dwelling you choose will be what dictates what is best for your own circumstances. I'll show you exactly what I mean by giving you an example at the end of the video using a property listing of each of the three dwelling types and how they could work in different circumstances for you. Let's rip in. First cab off the rank, we have Toowoomba, just 125 kilometres west of Brisbane. Toowoomba is in the Darling Downs region of Queensland, and it is a city certainly on the rise. Toowoomba's strategic location makes it well connected by major highways and railways, providing easy access to Brisbane and other key areas. On top of this, Toowoomba's Wellcamp Airport offers over 80 domestic passenger services per week and has an international cargo hub that's able to handle aircraft the size of the Boeing 747, connecting this region of Australia to markets across the globe. Toowoomba is the largest inland city in Queensland with a population of around 160,000 people, and it is forecast to grow to over 200,000 by 2046. It sits at number 16 out of 50 in the largest urban centre by population, so it is definitely a player high in the ranks. The Darling Downs has been called the country's food bowl, and the Toowoomba Regional Council area is the second most productive food region in Australia. But it is not just agriculture. Toowoomba is now widely recognised as the well drilling and servicing hub for onshore gas in Australia. Toowoomba has many advantages over those considering a new location with a lower cost of living and doing business compared to capital cities, has state-of-the-art health and award-winning education sectors, and capital city lifestyle mixed with country charm. Toowoomba has a very healthy infrastructure project pipeline, having a ton of committed funding in the Queensland 2023 and 24 budget as per the released regional action plans. As you can see on the screen, there's $1.1 billion for infrastructure and capital works, $1.3 billion on health, $64 million on education, and the list just goes on and on and on. And if you look at the total funding of those projects over the coming years of each project and not just the 23-24 allocation, you get a good idea of the tens of billions of dollars being spent. And this is only state funding to the end of 2024, so it doesn't include federal or local government spend or private projects. So let's look at some of these other projects Toowoomba has in the pipeline, as they are very impressive and visionary. First up, there's the $2 billion state-of-the-art Bailey Henderson Hospital Master Plan that offers an unrivaled health and knowledge precinct experience centred around the new Toowoomba Hospital itself, valued at $1.3 billion, with construction starting this year. Toowoomba's strategic importance in transport is also being leveraged through the Inland Rail project, with the Toowoomba stretch of the project featuring the largest diameter diesel freight tunnel in the Southern Hemisphere. This project comprises of two separately funded parts in the region, including the $1.4 billion Gowrie to Helidon line and the $1.4 billion Border to Gowrie line. The $360 million Toowoomba to Warwick Regional Water Infrastructure Pipeline is also underway. Toowoomba's CBD is poised for a $250 million arts, culture, business and conference precinct, which looks super impressive for the city. There are also multiple renewable energy initiatives in the pipeline, including the $4 billion McIntyre Wind Precinct, which is already underway, and the $1 billion Big T Pumped Hydro Power Storage Project. Now here I need to stop and specifically mention the Toowoomba Enterprise Hub, one of the most significant transport, logistics and business hubs to be seen in Australia. Australia. As you can see here, it is a central location encompassing many major multimodal freight facilities and more than 2,000 hectares of industrial land. Toowoomba Enterprise Hub has three major stakeholders that is building it out. Firstly, Interlink SQ, which is a fully approved $280 million intermodal terminal, rail precinct and industrial park covering 200 hectares that is currently under construction. Secondly, we have Whitmac Industrial Park and Charlton Logistics Park building the $250 million Charlton Industrial Precinct to support industrial growth and attract manufacturing businesses to the region. And thirdly, the Wellcamp Business Park, which is a master-planned 500-hectare business park estate. Parts of the park are now operational, such as the $110 million major freight terminal and the $100 million Pulse Data Centre. More projects in the business park are planned and more are near completion, such as the $550 million world-class aerospace production facility, where Boeing will manufacture cutting-edge military aircraft. Now, this project has started recently. There is way too much for me to cover off when it comes to this visionary project, and all in all, the detailed elements of it, let alone the funding that is and will be injected into it. However, when fully operational, the Toowoomba Enterprise Hub will inject billions into both the local and national economy every year. I'll just touch on a few more projects before we wrap up. The University of Southern Queensland has a $200 million plus master plan upgrade to its facilities. Toowoomba is also getting a $197 million sports precinct that will provide a mix of high-quality fields and amenities for a variety of outdoor sporting activities and a district-level recreation park. The $650 million Southern Queensland Correctional Precinct Stage 2 is also underway. There's a $450 million Toowoomba Wellcamp Entertainment Precinct planned to be Queensland's largest, incorporating motorsport, driver training, Olympic spec sporting fields and a 40,000-person performing arts venue and more. And lastly, the $150 million redevelopment of the Toowoomba Railway Parklands. Now, this will transform the area into a vibrant urban space featuring residential, commercial and recreational activities. Now, that's all we really have time to run through today, but there's a ton more infrastructure projects and there is a lot more in the planning stage. These extensive projects collectively reflect Toowoomba's growth trajectory. This type of infrastructure spend isn't undertaken in a place that isn't growing heavily in the future. These projects also mean an absolute shitload of jobs, a shitload, and jobs need people and people need places to live. Moving on to the suburb we are going to profile exclusively for you guys today. Our pick is Kingsthorpe. Kingsthorpe is a rural suburb about 15 kilometres northwest of Toowoomba's CBD, known for its peaceful lifestyle and semi-rural charm. Kingsthorpe's property prices are significantly lower than those in nearby Toowoomba, making it an affordable option for investors and first-time buyers. According to CoreLogic, the median house price in Kingsthorpe has increased from around $290,000 in 2014 to approximately $559,000 in 2024, reflecting an average annual growth rate of around 7.8%. In 2002, the growth rate was 32.3%, dropping back to 7.6% in 2023, with prices beginning to re-accelerate in 2024. Diving a little deeper into the decade prior, between 2010 and 2020, Kingsthorpe grew by around about 43%, or 3.9% per annum. This lackluster growth rate is the opposite of the market dynamics of Kingsthorpe right now. Listing numbers are staying subdued alongside days on market at 11 days, meaning the market is primed for further short-term uplift. Historical growth data, especially in the decade prior, tells the story of a market that underperformed for a significant period of time. But, and it is a big but, the affordability of Australia's 16th largest populace combined with major infrastructure projects and regional development in the area means that the suburb of Kingsthorpe at this very moment offers strong short and long-term growth prospects. As you can see on the graph on screen, over the past 6 years, Kingsthorpe's population has grown at a much higher rate than Toowoomba in all but 2022, which came under by around 0.25%, which is minuscule. But this rebounded back in a massive way in 2023 by leading Toowoomba's growth by over 1.5%. No joke, the vacancy rate is sitting at 0%, and for the past 6 years it has never risen above 1.6%, representing a market that has a very healthy rental market for an investor in regard to demand heavily outweighing supply, which equates to stronger yields with continued pressure on rental prices to keep climbing over the national average. Kingsthorpe has a relatively low stock level, with limited new housing developments compared to larger suburbs and other pockets of Toowoomba. As of the latest data, there are about 4 houses available for sale and 0 houses for rent. If we were to look at the stock levels using the sales and listings data for the past month for houses, there works out to be roughly 3 months of available stock on the market. Less than 3 months worth of inventory means there are significant pressures on this market to keep growing in the short term, as demand keeps soaking up the available stock, and there is no immediate new supply coming online in this region to offer more housing stock. Approximately 82% of the properties are owner-occupied, while around 18% are rented. This high level of owner-occupier appeal means that people want to live in Kingsthorpe. With only 18% of rentals available for an area experiencing 0% vacancy rates, this paints a picture for a healthy market for investors to seriously consider. With strong rental demand and low vacancy rates, investors can expect healthy rental yields, currently averaging around 4.9 to 5.2% per annum. Kingsthorpe has experienced significant growth, which has outpaced rental increases, meaning gross rental yields have been impacted. But we expect this to increase up to around 6.4% over the medium to long-term 3 to 5 year outlook, based on the assumption you purchased a house today. Kingsthorpe offers a compelling investment opportunity for property investors seeking affordable entry points, strong and improving rental yields, and potential for capital growth. The suburb's strategic location near Toowoomba, combined with ongoing regional development, makes it an attractive option for both short-term rental income growth and short to long-term capital growth prospects. Stick around to the end of the next section and I'll run through particular asset types you could purchase and how they may work for you given your situation. Next up, we are going to talk about Gympie in Queensland's Wide Bay Burnett region. Located about 160 kilometres north of Brisbane, Gympie is a city to keep on your radar. Gympie has a population of around 56,000, with predicted growth of up to 61,000 people by 2036. Gympie is a hub of the Wide Bay region, which has a population of over 310,000 and is expected to grow to around 383,000 by 2046. Gympie is immediately north of Queensland's famous Sunshine Coast, and the Wide Bay Burnett region acts as its direct extension. Therefore, it is set to receive a large share of growing families searching for larger properties as the Sunshine growth continues on its own growth trajectory. As per the QMPP 2023 report, the highest concentration of funded infrastructure works over the next 5 years is in the Wide Bay region, with 18% of funded activity totaling $10.7 billion. There's also a ton of committed funding in the Queensland 2023-24 budget as per the released regional action plans. As you can see, there's $1.9 billion for infrastructure and capital works, nearly $850 million on health, and $56 million on education to improve and upgrade schools, and the list goes on and on and on. If you look at the total funding of these projects over the coming years of each project and not just the 23-24 allocation, you get a good idea of the tens of billions of dollars being spent. And this is only just state funding to the end of 2024. Again, not including federal or local government spend or private projects. Let's run through some of these other projects. To begin with, there's the $14.2 billion Burrumba Pumped Hydro Project, potentially the state's largest pumped hydro station powering an estimated 1.5 million homes. This is a mammoth project which will drive Gympie forward economically into the future. Gympie will soon benefit from the much-needed Gympie Bypass, part of the $1 billion Bruce Highway upgrade. Renewable energy projects are also in the pipeline, with the $150 million Lower Wonga Solar Farm, the $100 million Wallula Solar Farm, and the $200 million Munna Creek Solar Farm. Additionally, the $15 million Mary Valley Rail Trail project will convert old rail lines into a scenic trail for cyclists and pedestrians, highlighting the natural beauty and cultural heritage of the city. Lastly, the Gympie Regional Council is also investing $25 million in upgrading local roads and infrastructure to support the city's growth. These projects, again, aren't a full list, but collectively reflect Gympie's growth trajectory, driven by substantial investments across various sectors and, again, creating a ton of jobs and therefore the need for housing. The suburb we are going to profile exclusively for you guys today is Southside. Now, Southside is a residential suburb located just south of the Gympie CBD, known for its family-friendly environment and convenience to local amenities. Southside's property prices are competitive, offering affordable options compared to larger cities, making it accessible for investors and first-time buyers. According to CoreLogic, the median house price in Southside has risen from approximately $291,000 in 2014 to about $634,000 in 2024, reflecting an average annual growth rate of around 10.6%. In the decade between 2010 to 2020, the average growth rate was 1.11%. Yes, property prices only went from $333,000 to $353,000. So, whilst recent growth surges have been incredibly beneficial for this market, it underperformed for 10 years prior to the recent uptick, leaving the door open for further growth. It is essentially playing catch up, and the forward growth projections are very positive. Historical growth data indicates strong appreciation in property values between 2014 and 2024. For context here, the national average is 6.8%, so 10.6% that Southside's experiencing is pretty awesome, with a high probability for continued growth driven by regional development and infrastructure improvements. As you can see in the graph on screen, over the past 6 years, Gympie has led Southside's population growth up until 2022 and 2023, where Southside accelerated to overtake Gympie. And in 2023, Southside led by a massive 1.7%, demonstrating the appeal of the suburb. The rental market is tight, with a vacancy rate of around 1.1% according to SQM research. 9 properties sold last month out of 43 listings, which means there is about 4.7 months of stock available. When there is less than 6 months worth of stock, it represents a market with further pressure on prices predicted. This stock level has been trending down, and if it was trending up, the potential for this market could be telling a very different story. Currently, 56 houses are listed on realestate.com, with the majority of these under offer or old stock. And on the rental side, there are currently 41 properties for rent. Rental vacancy rates have remained below 2% since midway through 2018. So whilst there are more properties for sale and on the rental market, some of this stock is sitting online and not exactly new listings. Approximately 67% of the properties are owner-occupied, while 33% are rented. This mix ensures a stable market environment with consistent demand from both sectors, reducing the risk of significant price volatility. With strong rental demand and low vacancy rates, investors can expect healthy rental yields averaging around 4.9 to 5.1% per annum, but we estimate this to increase up to 6.3% over the medium to long-term 3 to 5 year outlook, based on the assumption you purchase a house today. Southside offers a compelling investment opportunity for property investors seeking affordable entry points, strong rental yields, and potential for capital growth. The suburb offers a family-friendly environment with parks, schools, and shopping centres nearby, enhancing the appeal to families. This, combined with ongoing regional development, means Southside is well positioned to benefit from enhanced economic activity, making it an attractive option for both short-term rental income and long-term capital growth. As I mentioned at the start of this video, we picked these suburbs because we believe they'll perform very well by providing both strong imminent price growth potential with strong cash flow. While we can give you these tips, you need to figure out yourself what asset you should purchase. That could be either a 3-bedroom or 4-bedroom house with or without granny flat potential, or possibly could be a duplex. For example, let's assume you have a smaller budget that allows you to buy a solid foundational property. Let's say a basic 3-bedroom, 1-bathroom house on a good sized block. We found this past listing as a good example. Here it is on screen, a 3-bedroom, 2-bathroom property in Kingsthorpe on a 1,100 square metre block with side access for a future granny flat that sold for about $460,000 just in March. 3-bedroom properties in the area are renting for between $450 and $480 per week. So let's say this one is renting in the middle of that range at $465 per week. So it's producing a 5.2% yield. If you had a little more to spend, here's a 4-bedroom, 2-bath in Southside on an 800 square metre block, again with side access for a granny flat that sold for $575,000 in January. We know that from looking on RP data that there are 4-bedroom, 2-bathroom houses on similar sized blocks renting for between $610 and $650 per week. So again, let's choose the middle of that range and rent it out at $630 per week, giving us a yield of 5.28%. By purchasing either of these, and with the growth we are predicting from the work our data team has performed, you'll achieve above average capital growth, especially considering these larger sized blocks, as it's the land that appreciates in value. However, at this stage, you haven't maximised your cash flow due to your lower budget. Strategically, you can then work on improving cash flow at a later time. Let's say you can release some equity in years 2 to 3 to add a granny flat. PS, we have a whole video on this and the link's down in the description. By adding your granny flat and spending say $150,000 to $200,000 on that project, you could then rent that out from $330 to $450 per week, depending on your region. Adding this rental cash flow with the rental cash flow from the original dwelling, you could be lowering your overall risk profile with 2 incomes and seriously pumping up your portfolio's short and long-term cash flows. But what if your investment strategy required you to maximise your cash flow immediately while still producing strong capital growth? Well, you could put a granny flat on it right away if you had the budget, but many of us don't. So you could look at purchasing a duplex property. Here is a past listing for a duplex in Southside on a 760 square metre block that sold for $590,000 just 5 months before the other examples I used. So a very similar comparison to our other Southside example in terms of block size and price. This duplex has a 3-bed on one side and a 2-bed on the other. We know from the sale listing that collectively they have a return of $800 per week, so they provide a 7% yield from the get-go. And you will still get similar capital growth to the 4-2 example in Southside given the comparable land size. So you can see here the different options you have. The comparison between the 3 different asset types demonstrates how you can choose the particular dwelling you need specifically for what is required for your particular circumstances and budget. This should be a careful consideration in your investment strategy, which will depend on where you're up to on your investment journey or what your portfolio needs. I will create a whole video specifically on the house versus duplex discussion in the coming weeks, so make sure you hit that subscribe button below. Before we wrap up, I'll give you a quick tip. Gympie has the Mary River that runs through it, so do your due diligence, especially your flood mapping checks. Well, that was a lot to take in, and thanks for sticking it out to me to the very end. Now, property investing is a tricky business, and there was a lot of information in this video. So if you want to, give us a call. We give a free 1-hour consultation on the phone to anyone that gives us a buzz, and we're happy to do so. Until next time, happy property navigating.